Street, fortunes are made and lost in seconds. But in the 1990s, one man turned deception into an empire and greed into a business model. His name was Jordan Belfort, and his firm, Stratton Oakmont, became one of the most notorious financial fraud operations in American history. This is the story of the Wolf of Wall Street. Jordan Belfort was born in Queens, New York in 1962. Raised in a middle-class family, he showed an early fascination with money and persuasion. As a teenager, he earned thousands selling Italian ice on the beach. Discovering that confidence and storytelling could drive sales as much as the product itself, he later said he learned a powerful truth. People don't just buy products, they buy belief. After briefly attempting dentistry school, Belfort turned to sales. Door-to-door marketing and cold calling sharpened his ability to influence strangers and overcome rejection. He became obsessed with persuasion psychology and the mechanics of closing a deal. In 1987, he became a trainee stockbroker in New York. He entered a world driven by ambition, commissions, and aggressive selling, where success was measured in numbers and pressure was constant. Then came Black Monday. The market crashed. Belfort lost his job along with thousands of brokers across the country. But he soon discovered penny stocks, cheap, obscure shares of small companies, lightly regulated and easily manipulated. Commissions were enormous, sometimes 50% per sale, far higher than traditional stocks. Belfort realized something critical: control the stock, control the story, control the price. In 1989, he and partner Danny Porush founded Stratton Oakmont on Long Island. Officially, it was a brokerage firm. In reality, it was a high-pressure sales machine built on persuasion and volume. Hundreds of young recruits were hired. Many had no financial training or market knowledge. They were taught scripts, dominance, urgency, and absolute confidence. Objections were treated as weakness. Hesitation was attacked. The office floor became a boiler room. Phones rang nonstop. Supervisors shouted. Deals were celebrated like victories. Brokers were trained to overwhelm hesitation and close fast, creating urgency and emotional pressure in every call. At the core of Stratton Oakmont's success was a scheme called pump and dump. First, the firm secretly acquired large blocks of cheap shares, often in companies it helped bring public through controlled offerings. Then brokers cold-called investors nationwide, promising insider tips, explosive growth, and limited-time opportunities. Investors believed major institutions were buying. They rushed in. Prices surged and demand appeared real, reinforcing the illusion of legitimacy. Then insiders sold their holdings. The dump began. Stocks collapsed and liquidity vanished within days or weeks. Investors were left with worthless shares. Stratton Oakmont kept the millions. This cycle repeated again and again across dozens of companies and thousands of victims. By the early 1990s, Stratton Oakmont controlled dozens of stock offerings. The firm employed over 1,000 brokers and generated massive commissions. Jordan Belfort was earning more than $1 million a week, becoming one of the most powerful figures in the penny stock market. With wealth came excess. Belfort bought a Long Island mansion, a luxury yacht, and exotic cars. Helicopters landed at his home. Private jets crossed oceans. Office parties became legendary symbols of reckless success. Drug use was open. Cash was thrown across floors. Employees competed for status and profit. Loyalty was rewarded with money and spectacle. Inside Stratton Oakmont, excess was culture and identity. Outside, suspicion grew. Regulators noticed unusual trading patterns. Stocks promoted by Stratton surged and then crashed in predictable cycles. Investor complaints flooded authorities describing identical scripts, false claims, and extreme pressure tactics. The Securities and Exchange Commission opened investigations. Soon after, the FBI joined, focusing on organized securities fraud and money laundering. Agents traced money into Swiss accounts and shell companies designed to hide ownership and profits. Recorded calls revealed manipulation strategies and coordinated selling. Evidence mounted steadily. By the mid-1990s, lawsuits surrounded Stratton Oakmont. Penalties rose and restrictions tightened. The firm's reputation deteriorated across financial markets. In 1996, regulators shut the firm down. The boiler room fell silent and the empire collapsed almost overnight. In 1998, Belfort was indicted for securities fraud and money laundering. Investor losses exceeded $200 million across thousands of accounts. Facing overwhelming proof, he cooperated with authorities, providing information on partners and operations. In 1999, he pleaded guilty. Sentenced to 4 years in prison, he served 22 months. The Wolf of Wall Street had fallen. For victims, the damage remained. Retirees lost savings. Families lost college funds. Trust in markets shattered. Many had believed the confident voice on the phone and the promise of opportunity presented as insider access. That trust cost them everything. After prison, Belfort was ordered to pay over $100 million in restitution to victims, payments that would extend for decades. He reinvented himself as a speaker and sales trainer, presenting his story as both caution and expertise. His memoir inspired a Hollywood film, transforming his criminal past into global notoriety. The legend grew beyond the crimes themselves. But beneath the myth lies a warning. The rise of Jordan Belfort exposed a weakness in financial markets: trust. Stratton Oakmont industrialized deception, turning persuasion into a scalable system. The boiler room became a factory of fraud driven by psychology and pressure. Today, similar schemes appear online and across markets through emails, cold calls, and digital hype. Technology changes, but human psychology does not. Greed, fear of missing out, trust, and confidence. These forces still drive financial crime worldwide. The fall of Stratton Oakmont closed one of Wall Street's darkest chapters. But its lesson endures, because behind every financial bubble, every manipulated stock, and every too-good-to-be-true investment, there may still be another wolf waiting. But the story of Jordan Belfort did not end with prison or restitution. In the years following his release, Belfort began rebuilding a public identity far removed from the trading floors of Stratton Oakmont. He entered the world of seminars and corporate training, presenting himself as a master of sales psychology and persuasion strategy. Audiences filled conference halls to hear him speak about influence, confidence, and ambition. He framed his past not only as a crime, but as a lesson in human behavior and ethical boundaries. For some, he became a symbol of redemption. For others, a reminder of unresolved justice. Restitution payments to victims became a continuing controversy. Court records showed that only a fraction of the ordered compensation had been repaid in the early years after his release. Critics argued that profits from books, speaking, and media appearances should have accelerated repayment. Supporters claimed the legal structure of restitution schedules limited what could be demanded. The debate reflected a deeper tension in financial crime: punishment versus accountability. Prison sentences may end, but financial harm often persists for decades. Meanwhile, the world Belfort once exploited was changing rapidly. By the early 2000s, online trading platforms democratized access to markets. Individual investors could buy and sell stocks without brokers. Information flowed faster than ever before. On the surface, it appeared that the era of boiler rooms had ended, but the underlying psychology remained. Fraud followed technology. Email spam campaigns began promoting microcap stocks in coordinated bursts. Anonymous newsletters claimed insider knowledge. Message boards filled with hype and fabricated rumors. Prices surged briefly, then collapsed. A digital echo of Stratton Oakmont's tactics. Regulators identified these patterns as modern pump and dump schemes, now operating at global scale and near instant speed. The persuasive phone call had been replaced by viral messaging, but the mechanics were unchanged. In the 2010s, social media accelerated the phenomenon further. Online influencers promoted obscure assets to massive audiences. Forums coordinated buying frenzies. Speculative manias formed around narratives rather than fundamentals. Some campaigns were legitimate enthusiasm. Others were deliberate manipulation. Once again, belief drove price. Financial authorities worldwide warned that new generations of investors faced risks similar to those of the 1990s penny stock era. The language had changed: cryptocurrency, tokens, meme stocks. But the emotional triggers were familiar: urgency, exclusivity, fear of missing out. The same forces that Stratton Oakmont brokers had once deployed over telephones were now embedded in algorithms and trending feeds. Jordan Belfort's story became increasingly cited in regulatory education and investor protection campaigns. His rise illustrated how charisma and persuasion can distort markets. His fall demonstrated the eventual reach of enforcement. His aftermath showed how financial harm can outlive prosecution. Culturally, the image of the Wolf of Wall Street evolved beyond the man himself. It became shorthand for unchecked greed, speculative excess, and the glamorization of wealth without scrutiny. Films, books, and media coverage often highlighted the spectacle of Belfort's lifestyle: yachts, parties, and extreme behavior, sometimes overshadowing the victims and systemic damage. This tension between fascination and caution remains central to financial crime narratives. Spectacle attracts attention. Consequence demands reflection today. Global markets are larger, faster, and more interconnected than in Belfort's era. Sophisticated surveillance systems monitor trading patterns. Compliance frameworks have expanded. Yet manipulation continues to emerge wherever trust meets opportunity, because markets are ultimately human systems. They depend on belief in fairness, confidence in information, assumption of good faith. When those foundations are exploited, fraud becomes possible regardless of technology or regulation. The legacy of Stratton Oakmont, therefore, extends beyond one firm or one decade. It represents a structural vulnerability, the gap between perception and reality in financial markets. Where persuasion can manufacture demand, price can detach from value. Where trust can be engineered, deception can scale. For former investors who lost savings in the 1990 schemes, recovery was rarely complete. Financial loss intersected with emotional betrayal. Many had trusted professional advice. Some had invested retirement funds accumulated over lifetimes. The collapse of promoted stocks erased not only money, but confidence in institutions meant to protect them. Their stories remain the quiet counterpoint to the louder mythology of the wolf. As years passed, Belfort continued speaking and writing, his identity permanently linked to the era he defined. Neither fully villain nor fully redeemed figure in public perception, he occupies a complex space in financial history, both perpetrator and cautionary case study. Ultimately, the story endures because its conditions persist whenever markets promise rapid wealth. Whenever authority goes unquestioned, whenever persuasion outruns verification, the possibility of another Stratton Oakmont emerges. Financial crime rarely announces itself as crime. It appears as opportunity, innovation, or exclusive access. It speaks in confident voices and urgent timelines. It rewards early believers and punishes late ones. And when collapse comes, it leaves behind losses dispersed across thousands of lives. The Wolf of Wall Street was not the first of its kind. Nor will it be the last, but its rise and fall revealed with unusual clarity how ambition, persuasion, and greed can converge into systemic fraud, and why vigilance from regulators, institutions, and investors alike remains the only enduring defense. Because in every generation of markets, beneath new technologies and new narratives, the oldest forces remain unchanged: desire, trust, and the promise of easy fortune. And somewhere, in some form, there may always be another wolf waiting.